Well, the Australian dollar is one more casualty of Japan's nuclear crisis. Earlier this month, it was at around $1.02. It's since crashed about 5 cents with another slide this morning. And Justin Smirk is a senior economist at Westpac. So, Justin Smirk, why is the dollar in the firing line?
It's really because we're a very small, highly leveraged economy, Nicole. So what happens is an environment like this with lots of uncertainty, there's some risks around the global growth story of what's going on in Japan. We're seeing commodity prices fall and a lot of risk being taken off the table. The Australian dollar falls with that. And also what's adding to it this time is the Japanese have a very high savings rate. And in times of risk, they actually become risk averse and bring their money back home again. So it sounds a little bit odd, but in times of crisis in Japan, the Japanese currency gets stronger, and that of course weakens our currency, less money here as well. So right now, with these global risks around, the Australian economy does what it always does and takes a big leg down.
So given we've got a weaker Australian dollar, the supply chain from Japan has been disrupted, will Australians start paying more for Japanese imports?
You'd think in the very short run that's a possibility, but most of these supply chains and supply runs are due with very long contracts, or reasonably long contracts. The Australian dollar reacts with a bit of a lag into prices, so what matters more is if the Australian dollar stays down here for an extended period of time. If so, you could see import prices starting to rise later this year.
And briefly, does the weakness in the dollar have any bearing on interest rates?
Well, it's more about what it says about what's going on. So right now the markets have taken off any risk of rate hikes because of these global uncertainties. If things get worse in Japan and it actually has an impact on the Japanese economy in a more material manner, like a major nuclear accident does happen, then that would actually have an impact on the rate view and could shift the risk to rate rises to rate cuts.
Justin Smirk at Westpac, thanks for joining us.
It's good talking to you again, Nicole.